Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, August 6, 2018, looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And so we've had three pretty hefty big up days in a row. One was a lot bigger than the other two. However, we talked about this when it occurred. This was on the 2nd of August, last Thursday. We talked about the fact that that was a big time up day, and it turned out to be a big time up day. You can see here today, we finally came into my $284.68 red line. That was put on the chart long time ago. We made a run for that number before, and then we're since rejected. Now we're back up here. We're actually going higher, and that's the point of me hanging at the upper range of this chart here. The point is that we're going higher. We should have higher to go. Whether or not we get through the old all-time highs or the all-time highs and sustain above that, that's a different story altogether. The reality is we should have another 15 to 20 S&P handles. That translates to $1.50 to $2 in the SPY. So somewhere in the neighborhood of 28.65 to 28.70 would be the next major area of resistance for the S&P E-mini futures contract. The all-time high in the SPY is 286.63, I believe, and that coincides with the numbers that we just discussed, somewhere in the neighborhood of about $1.50 to $2 higher in the SPY. That brings us to around where the old all-time highs were. Are we going to get through the old all-time high first shot? Maybe, maybe not. It's not that important. We're not going to just walk through the old all-time high on a daily chart closing basis first time up. It's possible. It's just not probable. We'll also note that the market is floating higher on very light volume. That can be the case. It often is the case. We've said it here many times. The path of least resistance in light volume is higher. It's to the north side. And that's pretty much what we see going on here. Today's volume was less than 40 million shares traded in the Spider. The average daily volume, and this is over a 90-day period, is a little over 68 million shares. And that's even down from what it normally is. You can see the black line down here in the volume. It's actually trending down because as the volume gets lighter and lighter over time, the average 90-day volume gets lighter and lighter. So that's where we are today. So even such, we're still in light volume, and the path of least resistance in light volume is still to the upside. We had this nice reversal day the other day on Thursday, another 2 days worth of follow through. Whether or not we go right up to those all-time highs tomorrow and or Wednesday, we'll see. We should get up there, and we might have to go sideways. We might have a trick trap fool and frustrate day in there somewhere. That's certainly possible. But we should get up to the old all-time highs. Now here's a chart of the IWM, and it's a slightly different look than what we just saw in the SPY or the S&P 500. So in the S&P 500, we're talking about very near to the old all-time highs, and we're really only a stone's throw away. We're one decent up day away, 20 S&P handles, 15 or 20 S&P handles, $1.50 to $2 in the SPY. But what's interesting is that we're still inside of this last breakdown candle in the IWM. Now, the IWM also has relatively light volume, so it's on par with the Spider's light volume. We're not that far away from the old all-time high. Let's just put this in perspective. Looking at a weekly chart, we're very close to the old all-time highs. We've just been going sideways after the last big breakup candle, and eventually this is going to build up enough energy, and it's going to be released in the upside, and we're going to do another new all-time high in the IWM. But what I just think is interesting to note is, and it's just a puzzle piece, it's on the table with all the rest of the puzzle pieces, is that we still have to get through this last breakdown candle. The high happens to be 168.72, so it's really not that far away from where we are now, but we still have to get through there to get to and blast through the old all-time highs in the IWM. Just thought it was interesting. We're in a slightly different look, slightly different position in the IWM. That's all. On a percentage basis, the IWM was up more than the SPY was. Therefore, we can say that the IWM had what's called relative strength against the S&P 500. As you know, the IWM is my favorite market leading indicator, and when the IWM is leading the market in the upward or the downward direction, we always want to take notice. It's another puzzle piece. It's another piece on the table along with all the other puzzle pieces. Eventually, the puzzle will give us a clear picture of what the next major move is. Right now, I have a pretty clear picture that we should see another move higher in these markets before any kind of meaningful pullback occurs. Thought we would take a quick look at the chart of the VIX. The VIX continues to fall. We had a couple of pop-ups late last week when the stock market had its stutter step. And then as you can see, as the stock market began to rise, we begin to once again fall away in the VIX below all the moving averages. We said that the likelihood was that lower prices were coming. We were trading in this bearish pattern for a long time underneath the moving averages. We tried to pop up last week, couldn't sustain anything above the moving averages. Here we are again falling away. Looks like the VIX wants to go lower yet. Today we finished at $11.27 in the VIX. Where are we going? Well, maybe we're even going back into single digits. We'll see. I think anything in the 10 neighborhood, 10 and a half, 10 and 3/4, 10 and a quarter, in that neighborhood is worth a longer term trade in the VIX. I think traders willing to wait, meaning if you were going to play with options, you have to give yourself several months out. But if you were willing to wait, I think if you bought the VIX in and around, let's say sub 11, 10 and a half, in that neighborhood, I think over time you're rewarded if you're able to hold the VIX for a while. The transport's my second favorite market leading indicator in either direction. As we know, the transport's had quite the move off the low, and here we are again approaching and getting through some old highs. These aren't the old all-time highs. These are just some highs, and we consolidated for a few days, built some energy, and here we are. Energy should be and looks like it is being released in the upward direction to get above, and had a good close above those former highs. The former high was 11,128, and you can see here that we closed at 11,161 and change. Here's a weekly chart, and you can see that this was former highs, but not the former all-time high. And that will be really the next run that the transport makes. You know, you'll see some resistance up here most likely and here, but this is close enough to where the old all-time highs are that it looks like the transports want to make a run for the old all-time highs. It just makes common market sense. A lot will depend on this week's close. Can we close above these old highs, these old weekly highs? We'll see. Today's Monday. It all will depend on how we close by the time we get all the way down the week to Friday. So these are weekly charts, or at least this one's a weekly chart. Therefore, the close is only important at the end of the week. So even though we had a good daily close today, we can close back inside of here by the end of the week, and this isn't as meaningful as it might have looked on Monday if that happened. Nasdaq market, triple Qs in this case, very near the old all-time highs. These are the old all-time highs just from a couple of weeks ago. We're approaching the old all-time highs. We'll see if we have enough mustard in the jar to get through them. If we approach these old highs, my guess is on the Qs, and this is a guess, it's not based on technical analysis where we have a predictability in front of us. There's no predictability whether or not we go past the old highs from a couple of weeks ago or we stall out at the old highs from a couple of weeks ago. Really, all that is a guess. We'll probably be right about 50% of the time making that prediction. So I'm not making the prediction. I'm just saying that I think we will get through those old all-time highs. When the tech sector leads and the IWM leads, and the IWM isn't leading to the old highs just yet, but we'll see if it can get up and play some catch up here. And if it does, and money is flowing into the tech sector and money is flowing into the small cap arena, so we have money flowing into what is risk assets, that means that money is not afraid, and that means money is betting on growth. Money is betting on higher prices coming. If that is the case, then the momentum in those type of growth areas can take stocks higher than most people think that they can. We've been through this before. Most people are expecting a market to top out, and it keeps going, and everybody has that deer in the headlights look. I'm not saying it will happen this time around, but we've certainly had to discuss it a number of times in these videos, so I'm just giving you a forewarning that if it begins to happen that way, just keep in the back of your mind, prices can always rise and they can always fall a lot farther and faster than people really expect that they ever can. By the way, we'll just take a quick pause for a second. Let me just make mention that I appreciate everybody's participation, posting comments under the videos. Please keep up the great work. The comments are beneficial to me. They're beneficial to everybody in the community. So please keep posting your very valuable and positive thoughts and insightful information. In addition, hit the like button and share the video with those people you think can benefit from this information. All right, so just wrapping up the cues, if the tech sector decides to ramp up, it's unlikely that we just stop at the old highs. And this was just made on the 25th of July. So keep in mind, it was just a couple of weeks ago. And here's an interesting chart. Here's the XBD, the Broker-Dealer Index. Now, here's a daily chart of the XBD. You see it's bearish. We're making a bearish pattern on the daily chart below all the moving averages. And you can see here that unless something miraculously happens in the upward direction, likely story is that we're coming down here to this double bottom area. It's only a few points away, but that's the next likely move based on this daily chart right now. It's just a bearish chart. It's not a chart you would say, I have to buy this, the momentum is to the upside. That's not the case for the Broker-Dealer Index. We're always looking at both sides of the coin in these videos. Whatever market we can find, whether it looks positive against a negative backdrop or vice versa, we're going to look at all the markets that we need to look at in order to put all the puzzle pieces on the table. Now, here's the XLF. Now, this is the different picture. The XLF, which are different financial related stocks, are pointing upward. We have basically just had a couple of day pullback in the XLF. We consolidated for a couple of weeks above the moving averages. We pulled back for a couple of days, and now we just took off to the upside, back to the old highs just from several days ago. But what this is telling us, it's telling us that it's trying to build energy in order to get through this next important level of resistance. What is that area? Well, it's right up in this zone here. This is resistance. That's why the XLF continues to go sideways. This is called chart vibration. It's going sideways. It's trying to build energy to bust through this old area of resistance in this range. We don't know exactly whether the resistance can be said it's at 2850, 2845, 2842. It's in this zone is where the market found resistance. So when the market was going up here, the high was 2836. We couldn't get any higher than that. Could we get to 2850 right now and then have to pull back for another couple of days? That's certainly possible. We don't know exactly in what fashion the market is going to be able to get through, if it's going to be able to get through a former area of resistance. But this is the process by which it takes. We travel up, we stall out, we rest, we eat some time off the clock, we go back and forth, we build some energy to bust through in a continuation move. That's the way we have to build energy to get through a resistance area. That's what it looks like is happening right now in the XLF. But keep in mind that the XLF still looks different than the XBD. So we have two financial related sectors contradicting each other. There's a divergence among the financials. That's telling us there's trouble ahead across equity markets in some way, shape, or form. So right now, I'm just going to file that away. I'm aware of it. It's a puzzle piece. Right now, it's a small puzzle piece. Remember, here's a weekly chart of the XLF. We can rally in the XLF all the way above $29, $29.10, even higher than that, and still close any week inside of $29.10, and this bearish pattern is still intact. So keep in mind, we've come over the last several weeks, we've come a long way from these bottoms all the way down here at 26.31, low of 26.35 the following week. So we've come a long way in just a few weeks period of time. Keep in mind, the long-term view of the XLF still is not bullish. It's still bearish as long as we stay closing any week inside or below $29.10. SMH, a pretty good leading indicator within the tech sector. This is the Philadelphia Semiconductor Index. SMH is the ETF that tracks that index. And you can see on the daily chart, we're above the moving averages. So this is bullish on the daily chart from a short-term perspective. But you can see already what I'm looking at. You see this breakdown candle high? What's going to happen when we get up to that breakdown candle high? Well, likely we're going to find resistance. When I go over to the weekly chart, you can see here, here's that weekly chart breakdown candle. The high is 109.50. Now, we're not that far away. Can we get through it? Of course we can. The high is 109.50. It's the same candle. It's the same period of time. Just wanted to reiterate, from the weekly chart to the daily chart, it's the same candle that we're looking at, the same price candle or the same price level. What that's telling me is that it's unlikely that the SMH is just going to waltz right through 109.50 without some kind of fight. Intraday, could we spike it up to 110, 110 and a quarter? Sure, that could happen. But are we just going to close a day or close a week above 109.50 just like that, just waltz right through it? It's possible. I just don't see it as probable. So it's something to be aware of as higher prices get right on top of us in the SMH. So we talked about the Qs going higher. We talked about the fact that the IWM could play catch up. The SPY is not that far from all-time highs. Now, we're not at all-time highs in the SMH. So longer term, this would be viewed as a negative, but we're not worried about the longer term right now. We're worried about the shorter term. Where is this going to be by the end of this week? Where is this going to be if, in fact, we do get above, with authority, 109.50? Well, then we're going to go right to the high here at 112. So between 109.50 and 112, there's not going to be that much resistance, because if the market's going to act as a magnet to 112, then we're going to bust through 109.50 and we're going to know it in short order. If we get through 109.50 pretty quickly, expect 112 to be much more resistant than 109.50 was under those conditions. Think of it like this. If 109.50 gives us a tremendous amount of resistance and we have to consolidate for weeks underneath that to get through it, then 112 will be less resistant than 109.50 was. If, for example, by this week we get above 109.50 and we start heading to 112, expect 112 to be very good resistance, because 109.50 wouldn't have been under those conditions. Gold. Gold continues to melt away. There's nothing that gives me an indication that I want to be long gold. I told you I couldn't be short gold. I was just playing umpire in these scenarios, just calling balls and strikes. It's down too much to short it, even though we were likely headed toward 1200. I don't know if we get to 1200, trick trap, fool, and frustrate. They'll get into like 1208, 1209, 1207, something like that. And then they'll bounce it up $20 just to drive people crazy. They do that kind of stuff. So you can't short it in the hole when it's down this much. And you can't guess where the bottom's going to be. If you guess it's going to be 1208, they'll drive it to 1195. If you are waiting for 1195, they're never going to get there. That's just the way it works under these scenarios. So we just leave it alone. Wait for gold to put in a sign and a signal of a trend change. Give us something to trade against. That's a different story. Right now, right here, just let it fall until it gives us a clear signal and an indication one way or the other. Crude oil tried to bounce up today. We got almost to the infomercial high. Today's high was 69.92. The infomercial high was 69.95. We finished down at 68.90. That's where we are now. Either way, this is still a bearish pattern again, and I hate to reiterate the same thing, but again, until and unless we can get above and sustain daily closes above the infomercial high, 69.95, this is still susceptible to lower prices. If we run higher and we start closing above the infomercial high, then again, we can take another run for higher prices, namely 72 and or even higher. But we had that one fake out here. Remember, we tried to close above this infomercial high right here. We closed above it one day, and the rest was history. It was just a trick, trap, fool, and frustrate type of fake out. So net, this pattern tells us lower prices are likely ahead, but until and unless or if we get above and close above, once again, 69.95, then we can certainly have the momentum shift to the upside and have this market brought up to similar to like a magnet around $72 a barrel. And with that, folks, I'm out of wind. It's everything I wanted to and intended to discuss tonight. So I'll give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.